Okay, here we go. So I'm going to share in this presentation why it's futile to look at analyst consensus numbers for earnings. And this is going to apply for Tesla earnings, but it's also going to apply for other companies. See, a lot of people, they're trying to find out whether or not Tesla will beat expectations and beat the so-called Wall Street numbers. And I'm going to share why that completely is nonsense and why it doesn't matter and why it just will confuse you as an investor. This is one of those presentations you can go back to and listen to and watch over, and it'll help you, I believe, in your investment journey. So here it goes. So the FactSet consensus for Tesla's Q4 2019 earnings is about $7 billion in revenue and about 43 cents earnings per share on a GAAP basis. Now, these are just two of the numbers I think that are most important. And the way that reporters and Wall Street use this is basically they're using it to create headlines. And so they're not really following Tesla's minute earnings, and they're not really understanding Tesla's balance sheet and income statement. And so they use these expectations or consensus numbers as a cheat sheet to create quick headlines. And so basically reporters will say, okay, so Tesla reported $6.8 billion. That means they missed revenue expectations. And that will make a headline. Or Tesla will report $1 earnings per share, and then that will be used to create another headline that says, oh, Tesla beat on earnings per share. And so these consensus numbers really are not really for the true investor. They're really geared toward reporters, for media, for headlines, and for lazy investors who don't really want to do the homework, but it's going to trip them up, and it all backfires. Being a lazy investor is going to backfire, guaranteed. So here's the problem with this. The problem with earnings consensus is that they come from a bunch of irrelevant analysts, and they don't come from the big owners and buyers of the stock. See, here's the thing. These analysts, they aren't the ones holding billions of dollars of Tesla stock. They don't really have anything on the line. A lot of these analysts, even from the big companies, they're covering, up to a dozen different companies, and they don't really have a vested interest in any one of them. And for them to come up with some numbers, it doesn't really mean anything to them. And they're not really looking into these numbers very carefully. But the people who own actually billions of dollars of Tesla stock, I'm talking about the big buyers, the big holders. These people, they're not going to rely on analyst expectations or a FactSet consensus. When you have that much, online with Tesla stock, you're going to come up with your own earnings expectations. I guarantee it. Think about it. Once you have, imagine you have millions of dollars even in Tesla stock as a personal individual. You're going to be very diligent in finding out, how much Tesla is making and what kind of expectations that you have for the stock. And the same thing goes with these big funds and individuals who hold billions of dollars of Tesla stock. Now, the people who own this much of Tesla stock, they have expectations. They have their own expectations that are separate from analyst expectations, that are separate from, let's say, a FactSet consensus number. And these expectations aren't necessarily a strict number. They're a range. And this range can vary, and the most important figures in this range are these four figures. One is revenue, two is gross profit, three is net income, and four is cash flow. And so the true expectations, the true kind of people who are owning Tesla stock in big numbers, they've got their own expectations within a range. And these are the expectations that really matter. So if you're going to get kind of sidetracked and look at the headlines, look at analyst consensus, you're looking at the wrong group of people. You need to look at the group of people that actually own a lot of stock. So the question is, what happens? How do you find out what those expectations are? And it's quite simple. You actually need to get really into the earnings, really into the income statements and balance sheets of these companies as if your entire life savings, let's say you saved up for 50 years and you have amassed, let's say, a lot of money, and you invested all of that money into this one company, and you've researched, and you're going to have your own expectations of the income and revenue, etc. And that's kind of the research that you're needing to seek out. Who are those people that are researching like that have a lot on the line? And there's some YouTube channels out there that some guys are picking like 10, 20, 30 stocks, and Tesla is one of them, and they're giving predictions of analyst expectations or their expectations. But that really is gonna, I think, lead you astray. You've got to go to the people that have a lot on the line, basically, for Tesla. And so once Tesla reports earnings, these big holders are going to see which of these numbers, the revenue, the gross profit, net income, cash flow, is out of range. And if it's out of range, is it because it's a one-time occurrence, or is it something that's going to be ongoing? For example, if Tesla delivers lower revenue, why is that? Is it a one-time occurrence, or is it ongoing? If Tesla delivers lower gross profit or net income than expected, then is that a one-time occurrence or ongoing? And another question is basically, does it change the long-term story of the company? Does it change the trajectory of the company? I spent a lot of time in my past videos talking about, hey, once you find a generational company, a company that can 10x valuation within 5 to 10 years, to basically hold on to it if it has a clear and probable path to 10x. And so once a company delivers earnings out of your expected range, then you've got to ask, especially if it disappoints, does it change the long-term story of the company? And if it does, then you need to make some adjustments. All right, so specifically for Q4, I shared this in my last Q4 earnings video. I shared basically a spreadsheet here, and the spreadsheet, here it goes. So on the spreadsheet, I kind of give not just my estimated Q4 revenues and gross profit and income, etc., but I highlight a range. Now, this is what you're really looking for. You're saying, okay, what is the acceptable range of these key figures? And so for revenue, I have a range of $7 billion to $7.4 billion. If Tesla delivers under $7 billion, I'm asking some big questions here. Like, hey, what's going on? Is it one time? Is it ongoing? Like, what's happening here? If it's above 7.5 billion, then yeah, I'm pleasantly surprised, but I'm also asking those questions. Operating expenses, 950 to 1.05. Income from operations is 400 to 550. And then you've got net income, which I'm expecting at 150 to 450. So 150 to 450 million dollars. And that's a wide range, and that's okay to have a wide range because, hey, there's some flexibility. I'm expecting Tesla to have a better quarter than Q3, but there's some limitations because they have a set amount of revenue and gross margin, so it's hard for them to go above, I think, $450 million. EPS, which I don't think matters as much as long as you look at the income, but if you want to look at that, that's 83 cents to $2.50. When Tesla's earnings shareholder drops, I'm pulling out these numbers from their shareholder letter and I'm entering them into this spreadsheet. I'm going to look at making sure these key numbers are within range. And if they are within range, I'm pretty happy, right? And then I'm focusing the rest of the earnings call on long-term kind of strategic questions, how they're doing in terms of the health of the company. Okay, I'm going to take a quick pause here. Can you guys, in the comment section, let me know if you guys are still hearing me okay, and if it's laggy or not, and if the slides show up? All right, I'm going to go ahead and continue on with this live presentation here. One of the interesting things to look at for Q4 is S&P inclusion. If Q4 has net income on a GAAP basis of at least $265 million, then that means in the following quarter, Q1 of 2020, Tesla needs just $1 of profit in order to be eligible for S&P inclusion. Now, how does this work? Basically, Tesla needs, for the past 4 quarters, needs to show a profit, and the last quarter needs to be profitable. And so Q1 of 2019 was a huge loss, I think like $720 million or so. And so once that gets off of kind of the books here, then Tesla will, I think, have a clear path to S&P inclusion. The only question mark is, will Q1 be profitable or not? Now, I think Tesla has a good chance of being more profitable than $265 million for Q4. The question is Q1 going to be profitable? I think they have a good chance. So in the shareholder letter, I'm looking for any guidance. I'm looking to see if Tesla is indicating whether or not Q1 is going to be profitable or not. And if they are guiding profitability, now this is going to be super interesting, because if they fulfill that and execute that, they're going to be eligible for S&P 500 inclusion, and this could really throw off a lot of people. I don't think people are expecting this to happen right after Q1. I think most people who are expecting it, they're thinking mid-year of 2020 or late 2020. But right after Q1 of 2020 is amazing, and it's going to, I think, be quite the story. All right, I'm going to take a couple questions here. I pulled out some questions from some viewers that posted some questions in my past videos. Here's a question that says, what are your predictions on guidance? I think that's what matters versus Q4 results, which, as you noted, are bounded relatively tightly. If they say they're going to deliver 650,000 cars this year, stocks should go crazy. I don't think that's the most important number, but I feel the street will. Yeah, I have a different perspective. My perspective is, first, I think in terms of guidance, a reasonable number is about 550. If they want to be kind of more ambitious, 550 to 600,000 cars. I think Tesla theoretically can deliver more than 600,000 cars if Model Y ramp goes very well and if China production goes very well. But I think the more Tesla tries to give these lofty guidance goals, I think it actually hurts their credibility. And so I'd rather them give conservative goals and conservative guidance and beat that guidance very confidently. And so if Tesla and Elon say they're going to deliver 650,000 cars this year, maybe people will get excited, but I don't know if that's a complete positive sign, because the whole question mark is, guide for 650, but if you deliver 610, people think, you missed the mark. And so I prefer a lower number, 550 to 600, but we'll look out for it. And there's also a chance that Tesla doesn't even guide for annual delivery guidance this quarter. They might wait till the end of next quarter. Here's another question. By the way, go ahead and you can, in the comments section, you can go ahead and add any questions you'd like me to cover. If I have time, I'll try to answer some. Another question said, I sold all my shares today, not just Tesla, everything. I would stay out of Tesla for now until China resolves the coronavirus issue. Tesla is betting heavily on China, and with the crisis going on, it's not going to be great for a 2020 Q1 report and global trade in general. People are not going to be buying Tesla in China when people are dying on the streets. Also, trade is not going to be good with the virus going on. All right, so we got coronavirus. Yeah, we got several people posting in the comment section about coronavirus and how, there's a lot of concern. Now, first, I have a lot of thoughts on this. First, there appears to be a lot of hysteria around this coronavirus, and we don't have all the answers. And that's the thing. A lot of times with things like this, there's a lot of unknown. And that unknown kind of triggers fear in people, especially when it has to do with safety. Now, is it possible that coronavirus is like super serious? Well, sure, there's always a possibility when there's unknown, when everything hasn't been uncovered. But the likelihood is that coronavirus is not the second coming of the Black Plague. is something that is going to be handled and it's going to pass in time. We've got kind of the height of the flu season going on in China and different places in the world. And this just heightens kind of the sickness around. And I'm curious, if we're really even going to be talking about coronavirus a year from now, or if it's just going to pass. The second thing is whether or not, this coronavirus will affect Tesla's China factory. Now, if Tesla stops production on their Shanghai factory for let's say 6 months, sure, it's going to have an impact on Tesla. But if you think about it, Tesla's factory is, way down in Shanghai, and sure, the coronavirus is spreading and it's, obviously in different parts of China. But if it affects a factory like Tesla's factory to the point where they have to shut down for multiple months, then it's going to affect basically almost every factory in the entire China, which is going to affect the entire global economy because everything is so interconnected nowadays. So what you're talking about is with this fear and hysteria, you're talking about an amazing amount. I mean, okay, I'll just say it like this. I personally don't think that it's that big of a deal for Tesla. I don't think they're going to shut down their factory much, if at all. And I think it's a non-issue as a Tesla investor. In terms of, the global economy and in terms of where this coronavirus will go, I don't know. But my general feeling is, let's wait for these unknown facts to come out before kind of, freaking out and saying that this is a huge deal. All right. Next question is, how do I listen to this Q4 call? Interesting. So go to ir.tesla.com and you're going to go tomorrow after 1 p.m. Pacific time, and you can read the shareholder letter. Now, sometimes Tesla releases the shareholder letter right away, within 30 seconds of the close of market. But sometimes they wait for 30 minutes or 40 minutes. One time when they changed CFO, it was an hour or hour and a half. And basically the new CFO didn't know the password to upload the shareholder letter. He never got that from the previous CFO. And so it was ridiculous. Anyways, you'll read the shareholder letter, and then around 3:30 p.m. Pacific time, you'll go to ir.tesla.com, type in your name and email and stuff, get into the streaming audio call, and you'll listen to Tesla's call. I'm considering doing this interesting thing of a live audio stream, so I'm thinking I might stream the audio conference call live on YouTube. And then what I'll do is I'll go ahead and type some comments next to kind of the conference call. And so it'll be kind of like a running commentary. So you'll get to listen to the conference call as usual. And so I won't interrupt. I'm not going to do an audio kind of over the conference call. I'll just go ahead and share my views as in text format. So it won't be a distraction for the conference call. So tomorrow, looking forward to it, definitely. All right, for inclusion into the S&P index requires 3 consecutive quarters of profit. How can Tesla be profitable in Q1 2020 when it's only profitable in Q3 so far, or Q3 2019 so far? This is a misunderstanding. You don't need 3 consecutive quarters of profit. You basically need to show profit in the cumulative past 4 quarters. So the total profit just needs to be positive in the past 4 quarters, and the last quarter needs to be profitable. So that's the eligibility criteria. Tesla has a good chance. Again, the magic number is $265 million. As long as they can report that in Q4, then Q1 just needs to be $1 profitable, and they can be included in the S&P, and it's going to be quite the show for Tesla. All right, that concludes my questions here. I want to go ahead and I'm doing this live stream for the first time, and I'm just able to see the comments right now. So if you guys have any questions right now, I'm going to look at the comments and go ahead and try to answer a few more things that come up. So it says, hey, Dave, some say the road ahead dictates share prices rather than last quarter earnings. Is that the case? Hey, you've got to put this simply. It's not last quarter earnings. It's not for, say, the road ahead. It's basically the big buyers. It's people who have a lot of money. Either they're in Tesla stock already, they have billions of dollars, or they're contemplating Tesla stock, or these are the people that generally, shape the stock price going forward. At least the stock price, I'm talking like the first maybe couple days. Sure, you have short-term traders and you have momentum traders, and it'll sway the stock price. But generally, the big moves of stock price are usually from big buyers and big sellers. And so that's the tricky thing with stock investing, is you've got to understand the mind of these big buyers and big sellers, or else you don't really have much of a chance to really, see where things are going. And that's where I think a lot of people with a trading mentality, see, I'm not completely against trading if you're good at it. If you're really good at it, you think you can make a lot of money. But in order to be really good at trading, you need to have an edge into the mind of the big buyers and big sellers. And a lot of times people say, oh, charts. And that can help you get an edge if you can really understand the charts to the point where it can dissect and give you understanding on the actions of big buyers and sellers. But when you're just looking at kind of shallow stuff, I don't think you have the right advantage you need to trade effectively. All right, so we have Harry Chu, short interest by daily volume is declining. Yeah, well, Tesla's short interest is interesting. It's still at about 24 million shares, which is quite high. And it doesn't seem like the shorts are covering that much right now. So in my opinion, it's like, yeah, there still is a lot of potential, a short squeeze or a short kind of, covering to happen, because you still have 24 million shares, at least I think it was like January 15th, short interest publication. And so you still have a lot of short interest. They're only covering minutely. New shorts are coming in. It's fantastic because you have these smart people who, at least they claim to be smart, The other day, it was one of these tech guys were saying that, oh, Tesla's overvalued. It's going to, drop like crazy. It was Kara Swisher's a partner was tweeting that. And he seems like a smart guy, who thinks he knows a lot about tech. But the problem is, the problem with smart people is they often look at a part of the data or part of the picture, and they think that they understand the whole thing. And so, for example, you look at, Tesla's profit versus their market cap, and they go, oh my gosh, Tesla is above $100 billion, therefore it's overvalued. And you compare Tesla's revenue with Ford's revenue or VW's revenue, and you think this is impossible. But you're not looking at the complete picture. There's so much complexity involved. For example, what's Tesla's position in each of the markets that they're in right now, and can the other competitors really outdo Tesla? What new markets is Tesla entering into? What's their revenue projections for the next few years? These are the things that these people who think they know so much, they just aren't looking into because they're not looking deep enough. And partially is a lot of times the culture of stock picking is one that's just shallow. You pick your stocks, pick, one of 20 stocks or have 20 stocks in your portfolio. But who are the people that are really doing the deep research, really going deep? These are the people who really own a lot of the stock, or who have a strong vested interest. And these people are able to understand more of the complexities better. But there's some dangers with people. I'll go into future videos and stuff of the dangers of even Tesla fans. I think they get very emotional when they look at Tesla. All right, so we got Jordan. Tesla is going to rip tomorrow. So I hope you don't mean rest in peace, man. I hope you mean rip as in going higher. But anyways, that's your opinion, and you're definitely you have all the right to to believe that. For me, yeah, I look at all probabilities. What's the probability of Tesla going higher tomorrow? It all depends, I think, on Tesla's how they deliver, not just the numbers, but whether those numbers really give evidence to Tesla's growing dominance in their markets. And if they can, deliver, I think, earnings within the range that I shared, I think that just strengthens their longer term story. And there's a good chance that, the buyers are encouraged. There's also this other side where you think about it where, sometimes expectations can be so high with the buyers that they've gotten in and they're looking for Tesla to deliver something that they can't deliver in the earnings. And sometimes a company can so-called beat these analysts' expectations, but you see a big sell-off on the stock because the big buyers' expectations were much higher than other people. So it can be a little tricky. What are your thoughts on Rivian, Dave? Rivian. So I would love to try a Rivian, test drive a Rivian car or truck. And I've never seen it in person, and that's the thing. I've always been a person that before I make my kind of full assessment, I really want to try out the technology or what I'm critiquing. For Tesla, I was able to get a test drive very early on in 2012. I actually emailed Elon Musk. I cold emailed him. Back then, he actually answered his emails. And I said, hey, I need to test drive this Model S. And the next day or two, I got a call from the regional manager who's like, well, I heard you want to test drive a Model S. We don't really have them in the stores yet, but I can arrange a test drive for you. And I was able to get an early test drive. But that said, with Rivian, I think they've got a uphill road ahead. And there's a few things going on. First, Tesla is just so dominant in terms of the ecosystem, the full ecosystem that Tesla provides. So they have superchargers, they have stores, they have service centers, they have insurance, they've got, over-the-air updates, they've got, autonomous or at least autopilot features. And most of all, they've got a huge advantage in terms of cost. So by Tesla going with scale and with the Model 3 and now Model Y production, they've achieved basically mass production. With mass production, they're putting out so many batteries and so many battery packs that they're now going into this stage of economies of scale where it's going to be hard for Rivian to catch Tesla based on the Tesla's costs. And so Rivian has to deliver something else that Tesla doesn't have, but Rivian has to do it significantly better than Tesla, and that's the challenge. See, whatever Rivian can do, they can't match Tesla's costs, and so they have to find another way to outdo Tesla. Rivian's whole thing is right now is like kind of like adventure, living adventure trucks, kind of like these off-road trucks, and that's kind of their angle. And I'm very skeptical on whether or not that is really a big enough niche, like electric trucks off-roading. Like, are people really gonna be into that? Especially with Rivian that doesn't have supercharging. Like, where do you go off-roading if you have to take a few day trip and you can't supercharge? There's just a lot of questions with Rivian, and I'd love for Rivian to be successful, but I just think that Rivian has an uphill battle, and I would be very surprised. I think personally maybe out. And Jeff Bezos, he's got a lot of money. Amazon's got a lot of money. They could invest into Rivian like billions of dollars over the course of the next 10 years to establish a significant auto company. Now, this brings me to another kind of interesting idea, which is the idea of transportation of goods as a service. See, everyone's talking about robotaxi and Tesla network, but a huge multi-trillion-dollar market that not many people are talking about, but I guarantee you Tesla is exploring, is the transportation of goods. Basically a shipping company. And for Tesla to do this, it's very simple because they've got all the vehicles, they've got the autonomous driving that will be rolling out in the future. You just need to stick, have different places where people load and unload things. They can even solve that through robots, but Amazon, the shipping business is existential to them, meaning their shipping costs are a big percent of their costs. And so for Amazon, when they look at Tesla, I believe, as a competitor in terms of shipping down the road. 10 to 15 years down the road, Tesla might be a huge shipping, mega player. And Amazon could be kind of scared at this point where they feel they need to come out with an alternative, an autonomous, electric transportation system. And for Tesla to do that, or for Amazon to do that, they have limited choices, right? They could wait for other car companies to do that, but who's going to really provide that? Is GM, is VW, is BMW, or Toyota really going to provide an autonomous electric vehicle transportation system where Amazon can use to compete with Tesla on shipping costs? That's unlikely. And so, Amazon will likely have to create their own autonomous vehicle network, whether it's a combination of semi-trucks and local small trucks and smaller vehicles. I don't know. But it makes sense for Amazon to buy Rivian to build that company of the future. Amazon has already invested in Rivian. I think it was about $500 million, and I believe that was the main reason. They wanted to put in some money to keep tabs on Rivian so that they could potentially invest more or potentially probably take them over. This transport as goods and also transport of people, this is a huge multi-trillion-dollar market. And we're talking not just Amazon, but Google is very, very interested in this with Waymo. It's because during transport, there's so much time also that people spend in their cars, and all of that time is time for consumption. And Google's existential lifeline is attention. Basically, they're monetizing your intentions and what you're looking at and looking for. And for Google to be excluded from monetizing all that time in transportation, that's a big hit for Google. And that's why Google also looks at Tesla as a competitor in terms of 10 to 15 years out. And that's why Google is spending billions of dollars in Waymo to try to establish a transport, autonomous transport network. And so this market is just getting started. I mean, we're still in the first inning or just starting, top of the first inning in terms of autonomous transport network for goods and services and people. And we're going to see, I think, the biggest tech companies in the world, they're going to be battling out for this. And it's Tesla's game to lose. There's going to be other players, but Tesla is in the lead. And that's, a huge thing. Not many people are even talking about this. But that's, another reason why, you could be bullish on Tesla. All right, guys. Thanks for joining me on this live chat. Sorry I wasn't able to get to most of your questions. This comment stream on my live software just kind of zooms past all these comments so quickly. So it's hard for me to pick up on a lot of what you guys are saying. But I appreciate you tuning in, and I appreciate the questions and the feedback. And I'm looking forward to tomorrow's earnings report, and I'll go ahead and share some of my thoughts after the shareholder letter. I'm thinking possibly coming back live after the shareholder letter drops, maybe about 30 minutes or so after the shareholder letter drops. I might go ahead and come back live on YouTube to share my thoughts, and then also on the conference call, I'll try to do hopefully a live conference call stream where I type my comments as the audio gets streamed. All right, so this is kind of fun for me actually, so I'll continue on. So here we have, so we have a Dogen, sorry guys. Yeah, we have this Dogen buy-in. So Dave, would you recommend buying the Tesla stock before or after the earnings report? Yeah, so I get a lot of these questions like, hey, should I buy Tesla stock now or should I wait or whatever? Like, here's the thing. Everyone needs to make up their own decisions on, your stock purchase. And here's the reason why. First, I don't know your financial situation. Maybe you just have like a few $100 where you just want to, as a hobby, have one share of Tesla stock, that's fine. It doesn't really matter when you get it per se. Or you could be like some person who has like 6 or 7 figures and it's a significant amount and you're thinking, oh, should I go all in Tesla stock? And like, that's a completely different situation, right? And then there's 100 or 1,000 different scenarios in between all that. So it's really difficult for me to say, whether or not you should buy Tesla stock now or later or whatever. For me, all I can tell you is me personally. For me, I'm not like a person. I used to think, typically when I was first learning about the stock market, like 20 years ago or so, I was more in the conventional kind of line of thinking of, oh, I need a big portfolio of 10 or 20 stocks. And, I would just try to, buy some, and then if it would go up a lot, I would sell it. But maybe about 13 years ago or so, I had kind of like this season of re-examination, and I spent a good part of a year just kind of diving into forming my own investment philosophy, which I thought could, bring in multiple times the amount that other types of investment approaches, provided. And so with that, when I formed my investment philosophy, I started to realize that, hey, I think people are missing out on some really big opportunities because they're not researching and they're not really believing that they're able to catch the big 10x or 100x opportunities. And most people, they're not even looking for those type of opportunities. They're just trying to pick a stock and try to have 10%, 15%, gains for the year in their stock portfolio. And so once I did this, I shifted personally my investment philosophy where I am very concentrated in my investments. Now, in terms of like diversification, I have a kind of a complex view on this, but I actually believe in diversification to the point where I do think it's wise to have your basic living costs covered, or somehow I believe once you can cover your living costs, for example your rent or your food and just basic living costs, after that point you can become a lot more aggressive and you can take more risks with investments. And that's where I kind of have a two-part investment philosophy. One part is like, hey, yeah, I think you should take care of your basic needs, and there does require some level of conservativeness, where I wouldn't bet the farm, on everything if you can't cover your basic needs. But once you've covered your basic needs, I think there's a big argument that I actually buy into, where to be so diversified after that case is kind of is scattering your interest so much that you're not able to dive into and really seize the big opportunities that are out there. And that's where, like, in my case, I'm looking for those big opportunities and I'm looking to dive deep in. And I believe that Tesla is, for example, not the only company that has a 100x possibility from $30. I think there are many of these opportunities out there. I just don't think that a lot of people are in that position. And I think the culture of the day also is so short-term focused, is so just on this stock picking, You hear a stock name by someone and you just try to think, oh, I'm going to just buy some shares. And there's not much research or deep thinking going into investing nowadays. A person like Warren Buffett is, I think, very unique in that sense, where he thinks long-term. But I also think a lot of times with Warren Buffett, he's limited a lot of his investing kind of potential in some ways because he's serving a lot of people who have pensions or pension funds. He's serving a lot of people who have their retirement funds in his stock. And so he's he's forced to be more conservative. And he's shared this in interviews before, where he's very cognizant that people have, money that they can't lose in his company. And because of that, he has to kind of look for something different. He can't look for, well, he can, but he's going to be looking for a different type of stock, and I think that actually hurts his investment return. I think if Warren Buffett was actually to be investing for himself, he would go for much higher return stocks, and he would find a way through research and through kind of his breadth of exposure to lower the risks that are involved in investing in these high return stocks. And so he has this one analogy where he's like, yeah, it's like baseball. You want to swing at a ball that's like a big fat ball, that comes to you, and that's the swing you want to take in investing. And you do that, you increase the size of the ball that's coming your way through a lot of research, through a breadth of understanding and knowledge, and through understanding kind of like how these companies work, how valuations work, etc. And this lowers the risk and increases the size of that baseball, coming your way. So when you take a swing, you've got a much better chance at swinging and knocking that ball out of the park. So yeah, I think the thing that Buffett did was he took other people's money because he didn't have a lot in the beginning, and that's kind of his choice, and he's kind of continued down the path. I can't argue with him because he's one of the richest people in the world, so he's done something right. But that's my take on kind of Buffett. All right, I got another thing, man. See, I can go on for hours on this Tesla, just because I personally have spent so much time on Tesla. There was a period of between 2013 and 15 where I was pretty much full-time, just on Tesla and Tesla stock. So here's this guy, Damien. He says, I have a long-term bullish view on Tesla, but in the meantime, I see opportunities and options regards to Tesla. Jack Richard, for example, is playing Tesla both up and down with options. Yeah, so I don't know much about Jack Richard. I mean, I saw like 1 minute of one of his videos where he was trying to explain the options, stuff he's doing for Tesla. Here's my perspective. I do have, a decent amount of experience, doing options with Tesla since, back in 2013. And there's been a lot of option plays where I have actually, done very well with, and there have been a lot of option plays where I haven't done very well with. But overall, by far, the biggest gains that I've had with Tesla options has been more with these longer term leaps, they call it, where their expiration dates out at least 1 to 2 years out. And there are times where, say I pick up some leaps when I know Tesla is like super undervalued, and I just see, there's a huge opportunity ahead, and you're basically leveraging your position with, buying kind of long dated option calls. Now, the tricky part with options is you never can predict sometimes the volatility or the unpredictableness of Tesla and Elon Musk. Like, case in point, 2018, who would have predicted that Tesla would have had such a tumultuous year, not just with production ramp, but also with, Elon Musk and his tweeting and, just all these episodes, even with the SEC and all this stuff. And a lot of those things are hard to predict. And even Tesla, announcing just terrible Q1 earnings in 2019. Like, this is the time where Tesla should have been like just going crazy as a stock price. They should have been making profit, but Tesla just had a period in their history where they just went through some incredibly difficult times. And so it's extremely difficult to, I think, predict some of those times. And you can you can do that, and it's up to you in terms of to understand the risks involved. Now, there's another way to play options. I mean, there are many ways to play options, but another way is like some people sell covered calls, and what that means is basically you're selling these calls where if Tesla, for example, goes past $700 by a certain date, that you will sell your stock for $700. And in return, you get what they call options premium. You get a small amount of money that the other person pays for that contract. Now, the problem with that is Tesla is so volatile. Sometimes it just kind of skyrockets up. And I've seen in the past people selling calls when they think that Tesla's not going to go up, but it just shoots up and then they lose all their stock. And sometimes they have to pay tax on it, and they never get back in to the same amount that they did before. Now, another way you can play options is you could sell puts, right? And basically selling puts, as I say, I sell a put for $400. I get premium for selling that put, and another person basically, if Tesla stock goes below $400, and I can buy Tesla stock for $400. So you basically, are buying or selling the right to basically, pick up stock at a lower price. The problem with that is that oftentimes you're just burning this money, because there might be weeks and times where, you're like making a lot of money selling these puts. But the problem is, if you want to make a lot of money selling puts, you have to risk a big percentage of your portfolio in terms of exposure. And once you do that, and Tesla just has this long run, you're just losing out on all this options premium. You're just like, all these puts are, expiring worthless. And it's like, I don't know what the point is, I think, and then there's more advanced things where you could do some type of you could sell calls and buy puts, or you could buy puts and sell calls, or you could do a bull spread, which is basically you sell the lower call or you buy the lower call and you sell the higher call. There are all these different option strategies, and I actually encourage you guys, if you guys are interested in options, to buy a bunch of books on options. I'm always like a fan of rather than just critique without knowing, actually have an open mind and learn about this stuff. And so, purchase, 10 to 20 books on options to learn. But in my personal experience, I think with what I believe to be a generational stock like Tesla, and for a stock that has a 10x potential within the next 5 or 10 years, I'm personally very happy with just holding common stock and letting that ride. And the reason is because I think if you were in a different stock that had maybe kind of more predictable kind of volatility, it would be easier to predict. Or if it wasn't appreciating so much or had the potential to appreciate so fast, then you could, the cost or the benefit of playing options and having some increased income would maybe outweigh, right, the potential profit you have in a stock. And so I'm totally not against options generally speaking, but I think, for example, my first stock purchases with Tesla were $30 in 2012. I know a lot of people that sold cover calls at $40 or $35. They thought that they were just it was easy money, right? And I've heard this over and over, back in the day, people were saying, yeah, $35 cover call, easy money, right? $40 cover call, easy money. And I'm like, are you guys serious? It's don't you know, if you just wait 5 years, this stock could go up to $40 billion. You could have a 10x on your hand, but yet you're just trying to pick up the pennies, right before the steamroller comes. It's like, I mean, I don't know if that's the right analogy, but you get what I'm saying. It's it doesn't make sense, I think, if you're doing kind of my type of investing where you're going for these big generational, opportunities. If you have a 10x opportunity, it's the most important thing, in my opinion, is you acquire as much stock as you can early on, where you think it's at a low or fair valuation, and you hold on that stock as long as that company is executing toward their 10x potential and goal. And to me, that just seems like a much more solid strategy in terms of this type of company. Now I know there's a lot of like people talking about a lot of stuff out there on YouTube and elsewhere, and I'll leave it up to them. That's their right. They can talk about all that stuff, but my opinion is, hey, I've held Tesla from 30 to 300, and I'm looking to hold Tesla from 300 to 3,000 as long as they continue to execute toward their path, of reaching, their 10x valuation potential. Now, this is different, and then some people, there's like some Tesla bulls who are like, oh, I'm never selling until Tesla reaches $3,000 or something, or I won't sell a share until $5,000 or whatever. And I kind of don't agree with that type of perspective personally. In my opinion, it's kind of like this blind kind of, oh, I'll just, I won't even consider selling. And that's not my approach. My approach is the company needs to be executing, right? And if the company fails to execute and they lose the core kind of advantage and the core foundation of their story, of their long-term potential to be a 10x company, then I'm out of that company, One example was with Solar City. When Solar City was started to get going in 2013 and 14 as a public company, their earnings and their revenue were just like growing. Their install base was just growing so fast. And I liked their growth, and I liked Solar City. I was able to get in at $14 right after IPO. However, when Solar City started to get, and it's a complicated story where the growth started to taper, but also there started to be this massive propaganda campaign, and almost what's equivalent to like a bank run, on the stock, where they were basically getting kicked out or prevented from accessing different capital markets. And because of that, Solar City was suffering, and that's when I was like, hey, and I started to, dive into this. How are the executives viewing this? What's their strategy? How are they going to access credit markets? How are they going to reverse, their lowered growth rates, and how are they going to, bring profitability? And I wasn't satisfied with their answers. And that's where I'm like, hey, I'm out of this thing, this Solar City, I don't think they're executing on what I think their potential before was. And that's where you need to pull. You need to pull if the company is not executing, if the company's story is changing. And that's how I differ from some kind of blind or emotional, I won't say emotional, but it's kind of some gung-ho bulls. They're kind of like, no matter what, I'm holding Tesla even till I die or something. And I mean, that's fine. Everyone can make up their own investment strategies. But personally, I like to look at it more objectively. I'm not emotionally attached to Tesla as a stock. I'm an investor, and I'm looking at this objectively to see if this is a good investment opportunity. And that's my perspective on that stuff. Roland G, do you see Tesla paying dividends in 15 years? Yeah, so that's the whole point with investing in stocks. If a company never pays dividend, then it's like, you'll never get your money back unless you sell the stock, right? That's basically, there are two ways to get your money back from stocks. Either one, you sell your stock, or two, you keep your stock for an indefinite amount of period and you receive money through dividends. And so the eventual goal of a company is to return value to shareholders. And so at a certain point when the company is producing enough cash flow and enough profits, the companies should pay dividends, and especially if they have more cash than they need. For example, they don't have enough opportunities to invest, or they have already invested all they can and they still have leftover cash. And in that case, Tesla will be paying dividends. When will Tesla pay dividends? That's the thing with as long as Elon Musk is in charge, it's like Elon has so many ideas in terms of how to use capital. And the thing about Elon is he's got this thing where the combination of having first principles and understanding kind of how business works and having a passionate interest in how the future turns out, all of those combined leads Elon Musk to create and to think of these out-of-the-box new business ideas that might be massive in scale. And so in that sense, it's like, when will Tesla give dividends? It's, well, when their investments in new technologies and new projects and new things start to fade and they have a lot of profit. But with Elon, that can go on for a very, very long time, yeah, there could be a lot of different things. I mean, I can go on for a while with this, but also I won't. So I think, yeah, Tesla theoretically probably could start dividends in 10 years or so, and ramp up their dividends. And that's going to be an exciting time, especially if Tesla follows through with their autonomous driving plans. All right, so let's talk about autonomous driving here. I want you guys to add your comments here, but I think what Tesla has is they have an option call on autonomous driving. And let me try to explain this. See, Tesla as an automotive company, they actually have proven the skeptics wrong, and they've reached a point of sustainability where as an automotive company, they're able to cover their expenses with Model 3. With Model Y, all of that gross profit that they accrue from Model Y will largely translate and transfer right into their net income. And so Model Y is going to convert and transform Tesla into a profitable company. I think a very profitable one. And then you just continue on with Tesla Semi, with Cybertruck, with new lines of vehicles, etc. And Tesla as an automotive company, yeah, it's going to be very profitable, and in and of itself, right, I think it's going to overtake Toyota in the next few years. But the interesting thing is autonomous driving, in a way, is kind of a separate business altogether, because Tesla could be a successful, car company, but let's say they never even touched autonomy or autonomous driving. They still could do pretty well because they could partner with software companies to put sensors in and software into their cars and still sell a lot of cars. And so even, let's say, if Tesla never even tried to do any autonomous driving technologies, they still could be a very profitable, successful automotive company. So when we look at autonomous driving, what autonomous driving is an entire new business market or segment that Tesla is going into. And it's something that is kind of optional for Tesla, meaning Tesla's not dependent on autonomous driving to survive as a company. It's not existential to Tesla's existence whether or not autonomous driving succeeds or not, because they've already proven their sustainability with the automotive part. And so with autonomous driving, you've got this option call. So every Tesla investor who invests in Tesla, you're investing not just in an automotive company, but you're investing in an option call for autonomous driving and Tesla's plans for autonomous driving. Now, this I think is probably got to be the most amazing and awesome option call out there. Because think about it, autonomous driving is a multi-trillion-dollar market. We're talking about completely disrupting and transforming transportation as a whole. And if Tesla can succeed in really executing and rolling out a truly autonomous riding solution or transport solution, we're talking about a company that's tackling such a massive problem with such massive revenues that it's like you're talking about just a hugely important and valuable company. Now, what's more interesting about this is who else really is neck to neck with Tesla in autonomous driving. See, a lot of people in autonomous driving, they've kind of bought into this FUD that either autonomous driving is like 10, 15 years out, or autonomous driving needs LiDAR, or autonomous driving needs mapping, or all sorts of stuff like that. And because of that, they've kind of slowed down a lot of their, development. And now companies are starting to switch and to adopt more and more of Tesla's type of ideas. But the problem is Tesla has the full ecosystem. See, Tesla doesn't have just 5 to 10 or 15 or even 100, let's say, software engineers, working on software. Tesla has the entire ecosystem. They've got the brand, they've got the safety and the reliability, they've got the service, they've got the stores, they've got the superchargers, they've got the owner network, right? They've got the battery capacity, the cost, the drivetrain, they've got the sensors in the car, they've even worked out the beginnings of a Tesla network app as well. And with this entire ecosystem of autonomous driving, it's got to work seamlessly, and it's got to be easy for the end customer, or else the technology doesn't have a chance to reach the mass markets. And for these other autonomous companies, for them to really go beyond just like having this geo-fenced area in a small area, to really give service to a broad area, they really need to expand like everything they're doing. They need to, I think, combine a hardware and software solution and provide to the end user just like the seamless experience. I just don't think there's any software or hardware company, automaker or software company that is going neck to neck with Tesla. I think Tesla has the lead by far, and as autonomous driving rolls out, as long as Elon keeps his focus and keeps his clarity, Tesla has the likelihood to emerge as the winner in the autonomous driving field. Now, I differ from some people like Kathy Wood at ARK Invest who thinks it's going to roll out with millions of cars in 2021 or so. And I'm like, are you serious? Like, no, this stuff is going to take some time. It's like people aren't easily going to just get into a Tesla car and let it drive itself. I think there could be an interesting kind of middle stage where perhaps Tesla in certain geographies can release a robotaxi where it drives to a person using kind of the smart summon type of technology. So there's no one in the car. But when it gets to the person gets into the driver's seat, shuts the door, and there's a steering wheel. And the car drives itself, but tells the passenger that they need to take over at any moment. So it's kind of like there's driver oversight. And if Tesla can convince some people or some municipalities to accept this type of solution where they smart summon the cars to the people who are calling, the Tesla robotaxi, and the person gets into the front seat and oversees the car driving, make sure that there isn't problems, and if there's an accident, it's the person's kind of responsibility. If Tesla can get a few municipalities to buy into that model, I think that could be an interesting, actually a very interesting middle ground where they can start rolling that model to multiple cities. And as they roll it out to multiple cities, then they can continue to improve the autonomous driving, full self-driving features. And as they improve that, you're going to see a gradual shift where people are going to be overseeing the driving less and less, and eventually they can take out the steering wheel. But when will Tesla be able to remove the steering wheel? Yeah, I don't know. I just don't see it like something that's going to happen very soon in the next couple of years. I mean, maybe earliest 2022, but possibly 2023, where they can actually, in some municipalities, some cities, some areas, they can maybe remove the steering wheel. And I think this Tesla ramp robotaxi ramp is going to take some time. It's not going to be this instant thing. But that said, the potential for the robotaxi long term as it ramps out is so immense. This multi-trillion-dollar market, and it's like, it's just a beautiful business model where Tesla can take a cut, of every single ride out there. And for a Tesla investor, you're invested in that, and it's an option call, basically. It's like, yeah, Tesla could get into it, and it could fail in it, but still Tesla can be very successful as an automotive company and can justify high valuations just with that. But the robotaxi network as an option call, it's a very interesting kind of angle to think about it. Those are some thoughts with robotaxi. All right, Egosaurus. The only people who are more optimistic than Elon all work at ARK. That's true, man. I'm telling you, the folks at ARK Invest, there's some smart people there. I actually encourage you to take a look at ARK Invest as an investor more. Recently, I was looking at a presentation by Cathie Wood on YouTube where she talks about, I guess, some disruptive technologies, I think 10 or so, or that they're tracking. And every year, ARK Invest puts out a paper, a PDF presentation on kind of like the top disruptive technologies, right, that they're tracking and investing in. And I think that those are great, actually. They're so valuable. And I applaud ARK Invest for their research and for them kind of taking it from a different perspective. A lot of people, they're just looking at the short term, and then they, long term is optional. But ARK Invest really is looking at the long term. First, what are these disruptive trends? And then they're looking at more the short term. The only problem I have with ARK, or one of the issues, is when they look at the short term, they kind of tend to look at it so theoretically. Like theoretically, Tesla can sell, 1 million cars, whatever, next year. Theoretically, robotaxis can be out on the streets by the millions next year and all this stuff. And that's where I think actually it could be damaging or restricting, because I think the problem when you have overly optimistic targets and expectations is you underestimate the complexity of some of the things involved. For example, with robotaxi, some people who are just underestimating the timeline, or just kind of like, or overestimating how quickly the robotaxi can roll out. I think they're really underestimating how complex an autonomous driving network is going to be, and how complex autonomous driving software really is. And it's not like solving an easy problem. Like, this is intensely difficult software on the cutting edge of AI. And we're talking about lives at stake, safety at stake. And this stuff, like, it's not going to, be rolled out like instantly or easily. And that's where, when you have such an optimistic view on things, I think it could kind of shade your perspective too much in the perspective of seeing things as a theory. And I think if you get into a discipline and habit of doing that, I think eventually you start making mistakes and you start picking the wrong companies at the wrong time. For example, you think that this company is going to have this hit product, but you're just too early, too soon, and you're just not thinking of the complexities. And so, sure, ARK has made some good calls, and especially with Tesla, but it's like, I don't think underestimating complexity is a good habit to have as an investor. I think it has a cost, especially when you're picking other companies. It can really hurt your chances, and a lot of times, timing is essential too. You don't want to pick something that's like 10 years too early. You want to pick it at the right time. That's part of investing. It's like timing. It's like obvious. For example, it's obvious that a virtual reality is gonna come at some point, but a lot of the issue is timing, right? It's like which companies at what time. Yeah, like even cryptocurrency, I did a talk about Bitcoin, and a lot of it is like it's timing, like which coin or which cryptocurrency is gonna have the adoption, mass adoption, and it's about timing. And it's complex in that sense. What's interesting about ARK is that they're so bullish on Tesla, but they have to sell, their Tesla stock as it keeps on rising, which is so sad. I think they have like a 10% type of limit for each fund. And I think at 15% or so, it's like super max, and they have to start selling a lot. And if they really believed Tesla was going to $6,000, let's say in like 3 or 4 years, then if they had really strong conviction, then I would imagine you would tell all your people to exit your ETF fund and just to buy Tesla stock. I mean, they have said that it's their number one, conviction, Tesla stock. Yet they're restricted, to hold Tesla to a small percentage of their funds. And that to me is kind of sad, It's like, and well, it's sad for them, but on the other hand, it's an advantage for investors who just have the freedom to buy what they want to buy and to research what they want to research. All right, here we have Eric Mulder. Eric, how's it going? I know Eric. Eric is a long time Tesla shareholder from back in the day, back in 2013. He's held a good friend. So he says, "Hi Dave, I no longer get the notes from Adam Jonas at Morgan Stanley, but what do you make of his price target?" Yeah, Adam Jonas, like I'm telling you, like a lot of these over the years, here's kind of my analysis of these analysts. I just think these analysts don't have much time to spend researching Tesla. And it's partially because it's the nature of their job. They have to cover like 10 different companies, right? Like for example, Adam Jonas has to cover like all the automotive companies. So if you listen to some other conference calls for these other car companies, like Adam Jonas is there like asking questions, and it's like, so yeah, you cover like 10 or so car companies, and then it's not just you cover those car companies, but he's got a lot of other like duties. He has to manage people and teams and clients, and he's a busy guy. Like I really wonder like how much personal time he really does invest in Tesla. He probably has a bunch of research or a few research assistants, pulling these numbers. But it's like a lot of times I think the core thing about a generational company like Tesla is what makes it so special is the quality and the uniqueness of its product, right? For example, iPhone with Apple with the iPhone. The iPhone was this unique product. It was a desktop class operating system with a touch interface, right? Miniaturized in your pocket with a cell connection. And it was hard to copy, right? Because Apple just brought so much into that game. They already had desktop operating software experience. They already had hardware experience. They built a touchscreen interface. They had so much going already. And Apple was able to capitalize on that. With Tesla, it's similar in the sense that I think people mistake the Model 3 and Tesla's vehicles as like it's just another car, right? And if you look at these analysts, they all think that the Tesla Model 3 is another car. And because of that, they completely miss what's going on. They completely miss the revolution of the Tesla revolution. Basically, this Model 3 is a crazy next generation, vehicle that has a supercomputer in it that's connected, wirelessly and is upgradable, and it comes with the complete ecosystem, for transport as a service. And I think whenever you have an analyst who looks at Tesla, like it's kind of like looking at Apple back in the day as a phone company. Like they go, oh, Nokia, their max whatever market cap was 100-200 billion dollars, so that's the max for Apple. But they don't understand the iPhone and what's going to happen. And I think the same thing goes with a lot of these analysts. For these analysts, Tesla is just another auto company. The Model 3, the Model Y is just another car, right? And autonomous driving is something that may or may not happen, but it's probably a part of the fictional imagination of Elon Musk, right? And that's kind of the typical analyst. And so, for example, back to Adam Jonas, he's evaluating Tesla as an automaker, as a traditional conventional automaker. And as a traditional conventional automaker, they don't have the potential of entering multi-trillion-dollar markets like autonomous driving. And with conventional automakers, they're so kind of cutthroat in their costs, and they're so equally they're all in the same ballpark in terms of quality and features and stuff. There's not much opportunity for these car companies to grow much. And so you have an industry that's filled with just lack of growth, with lack of innovation, with low margins and high capital costs. And Adam Jonas is going to look at Tesla like that. And that's why he has that wide range of, things where he's like, well, it could be low, it could be high, I don't know, but I think it's pretty high right now, right? And that's pretty much the whole sentiment of these analysts. And as Tesla stock goes higher, these analysts are in a predicament because the market is proving them wrong, or is telling them that their thoughts are wrong. Now that's a tough place to be, because you have all these people who are saying, hey, Tesla's at 571 right now, and you told me that Tesla was gonna be at 250, or that's your price target. Like, what's going on? And so these analysts have this peer pressure now from the market, where they're thinking, oh my gosh, like the market is saying something different than what I'm saying. And the clients that these analysts serve are gonna side with the market, meaning rather than believing the analysts, which they know the analysts don't really have much stake in Tesla, and these analysts are covering, right, a dozen other companies, and these analysts don't have much time to research a lot. So, I mean, these clients are going to say, hey, you're obviously doing something wrong here. The market is, valuing Tesla at a completely different, with a completely different angle. And that's where the analysts start to play the chase game. And in the chase game, the analysts have to keep on bumping up their price targets, right? They have to bump up their price targets to 400, to 500, to 550, right? And watch if Q4, and I'm not going to give predictions in terms of, the stock price movement after Q4 earnings per se, because, that's up in the air. We don't even have Q4 earnings right now. But let's say hypothetically, Tesla, breaks 600 after Q4 and heads up to 700. It's like, the people who have price targets like $200-$300, even $400, now they're faced with all this reprimand and shame from Wall Street and the industry. And out of that shame, they have to, chase the price target. They have to chase the market's price, and they have to up their price targets over and over. And that's kind of like the story of these generational, companies. For example, with Apple, a lot of analysts, they just couldn't understand Apple. They're like, iPhone what, who cares? And they just never got it until the iPhone was showing the revenues that the iPhone brought in, right? Tens of billions of dollars per quarter. And that's when these analysts wow, I like the iPhone. Not because they like the iPhone, is because they like the revenue that these iPhones bring in. And so the analysts were the last people to understand the potential of the iPhone, right? For the analysts, it was all just about revenues. There are some analysts that kind of think ahead of the curve, and I give credit back in the Apple day, when Apple was making its big run with the iPhone, etc. There was Gene Munster. Some of you guys have heard about him. He's at Loop Ventures.com, LOUP, and he was actually kind of a rational Apple analyst who understood that Apple had a qualitative advantage with their products, that people loved their products, and that Apple could defend, right, that superiority of product. And throughout, probably a decade or so Gene Munster would defend Apple and explain kind of Apple's advantage. And that was actually helpful for a lot of, Apple investors back in the day. Gene Munster has left kind of the analyst position. I think he was at Piper. And then he started his own company, Loop Ventures, and he occasionally is still on TV and occasionally writes articles on Tesla. But generally speaking, all the professional full-time analysts on Tesla, there's really not a single one that I like, that I think is really looking at Tesla from a product standpoint, a qualitative standpoint, is truly understanding the superiority of Tesla's products. There's one guy, Trip Chowdhury. He comes on the Tesla call sometimes, writes some article saying that Tesla stock should go to the moon. Yet he doesn't have kind of a rational foundation. It's very emotional based, and that's where it's like, yeah, you can believe all you want, and you can make up stories of like how, high you want Tesla to go. But the reality is all companies are grounded in the appeal of their product, right? And so ultimately, Tesla's future is determined by how much people desire and want and pay for their products. And so ultimately, that will be the test. And and this is my personal opinion, great investors get that edge up where they understand what people want and what people will buy before other people, right? They understand kind of the superiority of certain products and services. They understand how and why certain companies can defend that superiority, and they understand why and how the masses will adopt that product. And when you can get in early on to that type of revolution in a product or company, that's your investor advantage in a way. And it's about timing, it's about foresight, it's about understanding kind of business, the core of business, what's the foundations of business, and what makes a business successful. And so anyways, sorry for actually not sorry, but that's kind of my long kind of rant on Tesla analysts and what I think about them. All right, guys, I've gone much longer than I anticipated, but it was actually lots of fun. Maybe next time I could figure out how to do video on this. But I hope you guys enjoyed the live stream. We'll see if I'm able to. I'll try something tomorrow. I don't know. When I attach my camera to this live stream, it kind of sometimes becomes laggy. I don't know if I need a new laptop or something, but we'll try something. I'll try to get back on maybe about 2 o'clock tomorrow Pacific time to share my thoughts on Tesla shareholder letter. And then I'll try to also live stream the conference call and add my text comments live during the audio stream. So anyways, good luck, guys. And thanks for coming in and joining this session. And we'll talk to you guys later. See you later. Bye.